Over time, economies tend to change, and one of the roles of economists is to assess those changes and try to shape them in a positive direction. Two concepts that are helpful here are economic development and growth. Economic development can be defined as an improvement in the economy's ability to contribute to people's well-being. Economic growth means an increase in the amount of marketed goods and services produced in the economy, which we measure using GDP. Economic development and economic growth are not the same thing. Economic growth can be one important way that we improve people's well-being, but well-being can also be improved in other ways, such as redistributing the goods and services that have already been produced. And sometimes economic growth can actually hurt well-being. So we'll come back to this concept of economic development in the next few tutorials. Today we'll focus on economic growth and its associated measurement, GDP. GDP, or Gross Domestic Product, is formally defined as the total market value of the final goods and services newly produced within a country's borders over a period of time. Usually we measure GDP annually, and sometimes you'll also see monthly or quarterly GDP reported as well. Now there are a few things that we need to note within this definition. First, GDP measures the market value of goods and services. We don't measure physical quantities because the goal is to come up with a summary measure of all the production in a country. And there's no way to add together, for example, 100 tons of potatoes plus 50 houses plus 90 haircuts and come up with a number that means anything. So what we do is measure how much each good or service is sold for in the market. That reflects the value that those goods and services have for people, and that gives us a way to come up with a single number to summarize all that information. Second, GDP only includes final goods and services. These are goods and services that are ready for their final purpose, either consumption if it's a consumption good, or production if it's a kind of capital. The reason we only include final goods and services is to avoid double counting. If we're looking at apple juice, for example, we don't want to include both the value of the apples that are used to produce the juice and the value of the juice itself, because the value of the juice already includes the value of the apples. So otherwise we'd be counting the value of the apples twice. The apples are called intermediate goods, so those are goods that are used to produce something else. Intermediate goods are not included in GDP, except insofar as they contribute to the value of the final goods that we are counting. Third, GDP only includes goods produced in the current time period. So for example, if you buy a used book from a bookstore this year, the value of that book won't be included in this year's GDP because it was produced and counted in a previous year. We would, however, include the services of the salesperson who sold you the book, because those services were produced in the current year. And finally, GDP only includes goods produced within a country's physical borders. So for Canada, that would mean goods produced within the borders of Canada. Canadian GDP does not include any goods produced outside Canada by Canadians living abroad. It also doesn't include any goods that were produced elsewhere and then imported into Canada. But it does include all goods produced within Canada, whether or not it was Canadians who produced them. There are other measures like gross national product that measure economic growth based on the citizenship of the people who were involved in producing them. So how do we actually come up with our dollar figure for GDP? One way to do that is called the production approach. To do this, you have to find out the dollar value of all the final goods and services produced by each sector of society. So you look at what households produce, other institutions like nonprofit organizations, what businesses produce, and what the government produces. And Statistics Canada collects this information for us. Then you just have to add up the values for each sector, and you're done. Another way is called the spending approach. Here you add up the dollar value of all the goods and services purchased by households and institutions, by businesses, governments, and by the foreign sector. So this means people outside Canada who are buying Canadian-made goods. You also have to subtract the value of any goods that Canadians import that were produced in other countries. A third way is the income approach. This involves adding up the incomes earned by everyone involved in the production of Canadian goods and services. So that includes the wages that are earned by workers, the profits that are earned by business owners, rents, which we call the income earned by people who own and rent out capital to be used for production, things like land or equipment, and taxes, which are income earned by the government. We also have to add in the money that we spend on replacing capital that has depreciated, because that gets subtracted from profit when you're calculating profit. No matter which of these three approaches you take, we should always come up with the same number for GDP. So it's easy to see why the production and spending approaches are the same. We're looking at the same transactions, we're just looking at it from the perspective of producers in the production approach and consumers in the spending approach. The income approach will also give you the same number, because when a good is sold, the money that that good is sold for is always income for somebody. So it gets divided up among the workers who worked to produce it, the capital owners who rented out capital to produce it, and the owners, as well as any taxes that have to go to government. In practice, the numbers that Statistics Canada comes up with when they're calculating GDP using the three approaches are similar but not exactly the same, and that's just due to some errors in measurement. There are a few more concepts related to GDP that we need to talk about economic growth. The first is the distinction between nominal GDP and real GDP. Nominal GDP is measured using prices from whatever year you're looking at. So for example, to calculate 2016 GDP, you multiply the quantity of each good produced in 2016 times the price of that good in 2016, add up all your totals for all the goods, and that gives you 2016 nominal GDP. The problem with using nominal GDP is that if you're looking at changes from year to year and you see that nominal GDP has gone up, you don't know if it's gone up because production has gone up or just because prices have gone up. So to make comparisons over time, we use real GDP, and that's measured using prices from a fixed base year. So you take the quantity produced in the current year times the price of that good in whatever base year you're using, and that base year is the same for all the GDP years that you're calculating. You multiply current quantity times base year price, add up your totals, and that gives you real GDP. That takes out the effect of price inflation so that you can be confident that if real GDP goes up, it did so because the quantity produced actually went up. And we'll see how this is actually done later in the tutorial. Another distinction is between total GDP and per capita GDP. So total GDP is just what we've been looking at so far, the value of all the goods and services produced in a country. Per capita GDP takes total GDP and divides it by the population. And this tells us, on average, how much each person in the country produces, or looking at it from the spending approach, how much each person in the country consumes. This is important when you're making comparisons between countries with different populations. So if two countries have the same GDP but different populations, whichever country has the bigger population has much less production and consumption on average than the country with the smaller population. And since we're usually concerned when we're talking about economic growth with how much goods and services is available to each person, per capita GDP is an important measure to have. And finally, the GDP growth rate is the percentage change in GDP from year to year. And this is calculated by finding the difference between the years, dividing by the value in the first year, and multiplying by 100%. And you can calculate the growth rate of GDP for any of the four types of GDP above.